Ladies and gentlemen, good day and welcome to Q3 and 9M FY23 earnings conference call of Hindware Home Innovation Limited, hosted by PhillipCapital Private Client Group Desk. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Apurva Shah from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you, Vivian. Good evening, everyone. On behalf of PhillipCapital India Private Limited, I welcome all of you to Q3 and 9 months FY23 earnings conference call of Hindware Home Innovation Limited. We take this opportunity to thank the management of HHIL for giving us the opportunity to host this post-earnings conference call. From management, we have with us today Mr. Rajesh Pachnu, CEO Pipe Business, Mr. Sudhanshu Pokhriyal, CEO Bath Business, Mr. Sandeep Sikka, Group CFO, and Mr. Naveen Malik, CFO of Hindware Home Innovation Limited. I now hand over the call to Mr. Gavin Desa from CDR India for further proceedings. Thank you, and over to you, Gavin.
Thank you, Apurva, and thank you for the introduction. Welcome everyone to this call. I'd just like to add that statements made during this call may be forward-looking in nature and are subject to risks and uncertainties. The management of the company does not take any responsibility to revise these in the interim or make any changes. I now like to hand over to Mr. Naveen Malik to start by giving his opening remarks. Over to you, Naveen.
Thanks, Gavin. Good evening, ladies and gentlemen, and a very warm welcome to Hindware Home Innovation Limited Q3 and 9 months FY23 earnings call. I am sure you would have seen the numbers in our presentation. Now, I will touch upon some key aspects of our overall performance and of our consumer appliances business, post which Sudhanshu will share an update on bathware business, and Rajesh will take you through the plastic pipes and fittings business. Our business performance should be considered in light of a challenging macro environment, whereas demand has been subdued, coinciding with the period of interest rate hike and high inflation, leading to slowdown in consumer discretionary spend. We have achieved decent growth in pipe business, but inventory losses impacted margins. Although our margin and profitability have been affected, our revenue performance remains healthy owing to our established brand and product acceptance. Our 9 months FY23 EBITDA increased by 40%, and we plan to further improve efficiencies by increasing local sourcing in our bathware and consumer business. Further, Hindware Private Limited, the joint venture entity formed between our company and a group Atlantic of France, has commenced manufacturing heating appliances at its advanced facility in Jagatela, Telangana. We are optimistic that the commencement of the new manufacturing plant will enable us to strengthen our market share and further consolidate our position in the water heater segment. I would also like to talk about a change in the status of Hindware Limited announced on 3rd February 2023. In order to incentivize and encourage certain employees who are critical for its business, the Board of Directors of Hindware Limited has approved the allotment of 9 lakh partly paid up equity shares or 1.8% of equity to members of its senior management team. Subsequent to the aforesaid allotment, the status of Hindware has been changed from wholly owned subsidiary to subsidiary of HHIL, with effect from 3rd February 2023. The shares are issued at a valuation arrived by an independent valuer and will also be subject to lock-in, release, and transfer restriction as may be agreed between Hindware and eligible subscribers. Looking ahead, we continue to focus on expanding our product portfolio, improving our product mix, expanding our distribution reach, enhancing operational efficiency, and implementing cost rationalization initiatives. We remain confident about our performance and will achieve sustainable profit and revenue growth for all our stakeholders. With that, I would like to call Mr. Sudhanshu Pokhriyal to take you through the bathware business. Over to you, Sudhanshu.
Thank you, Naveen. Good evening and welcome, everyone. So we are very encouraged by our performance for the quarter under review. In a period wherein market demand was muted, we have achieved revenue growth of about 12% in Q3 and 33% for the 9-month FY23, while, of course, gaining in our market share. Despite the calibrated price increases which we undertook across our product categories during the quarter under review to counter the effect of increasing input prices, we continue to see decent customer offtake, which we believe is a reflection of the success of our innovative launches and our strong brand salience. As a part of our growth focus, we've been strengthening our distribution network. In the year to date, we have added 123 new distributors and 29 in quarter 3 alone. We launched 186 new brand shops and 46 in quarter 3 alone, taking a total to nearly 425 operational brand stores for brand Hindware. We have expanded to many new Tier 4, Tier 5 towns because of distribution expansion initiatives and enhanced the brand awareness through focused advertising and promotion, which I'm sure you witnessed during the quarter as well. Our enhanced product mix and new product launches growth of our partners. Higher input costs combined with overall inflationary environment showed that saw the growth to be lower than our expectations though. During the period under review, we have introduced various innovative products and designs such as Spyro faucet range, PVD range of a colored faucet called Hues, more than 50 new models of EWCs in one piece and wall mount types. Our NPDs which are launched in last 21 months have contributed to more than 20% of our sales in this financial year. Our marketing campaigns across all platforms have been strongly supporting these launches. Our growth strategy is multi-pronged. First of these is consistently expanding our distribution and reach, and we believe there is still a significant opportunity in Tier 2 and Tier 3 cities. Nearly 70% of our sales comes from non-metro towns. Secondly, our focus is to continue to expand and strengthen our faucets business and institutional business while maintaining our position in the sanitary business. Our third area of emphasis is on strengthening our luxury brand Keo through a vibrant media and promotional campaign. All these efforts are underlined by a strong influencer program, which also includes the plumber and architect loyalty program, which plays a significant role in product decisions of the end consumers. We have taken strategic decisions to reduce imports and increase local sourcing to better safeguard us from the vagaries of international freight, foreign exchange, and international inflation. We believe this will help us to increase our efficiencies, which will start reflecting in the coming quarter performance. Further, we do not have any significant capex plans over the next year as we are not setting up any greenfield manufacturing plant. The capex we propose to incur in the coming FY24 will be setting up more brand stores to drive market growth and also on efficiency capex to optimize our own manufacturing capacity to build higher ASP and higher margin products. In the past 12 to 18 months, we saw a spurt of demand which was pent up during COVID. Currently, the inflation in cost of land and cost of construction, we believe the demand is going to be muted for at least two coming quarters. Additionally, home loan interest costs have increased, which is making customers a little more cautious while considering taking a decision to buy a home. Some big projects are definitely being launched because of the distinct shift sector is undergoing from unorganized to organized sector. Additionally, we also see many new players coming into sanitary ware and faucet business as extended categories of their existing business, as has been happening in the last 7 to 8 years. In this environment, our diversified quality offering supported by a strong brand and a thrust on aggressively expanding our presence and reach will help us in our endeavor to drive profitable growth. We believe we have the brand strength, manufacturing excellence, quality, system processes, and the team to deliver robust results. With that, I'd like to call Mr. Rajesh Pajnu to take you through the pipe schedule. Over to you, Rajesh.
Thank you, Sudhanshu. Good evening, everyone. Thank you for joining us. I'm glad to report that our pipes and fittings business continues to be the fastest growing in the segment, with revenue up by 41% in 9 months and 27% in Q3, year-on-year basis. EBITDA stood at rupees 2 crores in quarter 3, and in 9 months it came to at rupees 20 crores. Margin pressures persisted due to the decline in PVC raw material prices, leading to huge inventory losses, which stood at around rupees 17.5 crores this quarter. Since December 2022, as you all know, our prices have stabilized now and begun to rise. Further, should PVC prices remain at present levels or don't fall again, we expect no further inventory loss in Q4, which is already reflecting in our January performance, and believe we are well positioned to deliver early double-digit margins. Despite the persisting macroeconomic challenges, we are happy to report that our business has witnessed encouraging volume growth in the last 2 quarters. This growth is driven by our CPVC pipes and fittings, which presently contribute close to 45% of the pipes business 9 months revenue. Our focus on expanding our distribution and reach continues. We currently have a network of over 290 active distributors, along with approximately 25,000 retailers. Our expansion strategy, including both brownfield and greenfield initiatives, aligns with our planned objectives. Our Hyderabad plant brownfield capacity expansion project commenced commercial production in January 2023, increasing our capacity to 48,000 metric tons. Additionally, our greenfield project in Roorkee is progressing as planned, with the new plant expected to commence operations in mid-financial year 25. Considering the sale of around rupees 200 crores which we achieved in the past quarter, we are hopeful of the growth construct for our pipes and fittings business. We in fact anticipate that the business may exceed its target of achieving rupees 1,000 crores in sales well before its stated financial year 25 target. That concludes the opening remarks, and I would like to ask the moderator to open the floor for questions and answers session. Thank you all.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may kindly press star 1 on your touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kaushal Shah from Dhanki Securities. Kindly proceed.
Thank you very much, sir, for the opportunity. I had 2 questions. One on the bathware segment, if you can maybe throw some more color on the drivers for the margin expansion that we've seen in Q3. That is one. And the second is on the pipe segment. We've seen, you mentioned in your opening remarks about the 17 crore inventory loss. So that seems a little higher compared to some of the peer companies, particularly also given that your commentary in Q2 was that we're not expecting significant inventory loss. So where do we see pipes, while the volume growth continues to be quite strong, but where do we see the margin going forward in the pipe segment?
So I would request Sudhanshu, if you can take on the bath one, what are the key drivers, and followed by Rajesh, if you can throw some light on, although you have spoken about inventory that going forward not there. So still, talk about the inventory. Or maybe you can talk about the inventory and followed by, Sudhanshu.
Yeah. I'll answer it. Sir, I'll answer your first question. The second question, that's on the pipe side, since we have already said. What happened is, in the last quarter, the prices of PVC raw material nosedived from 126 to 99,000 per metric ton. It was almost around, the 30% drop in prices in a single quarter. And we were carrying some inventory. So that was the reason. And as I said, that this looks now positive because the market has gone up by a few rupees and per kg, and also we have realized it. And as I said already, we are on a right January is already promising, the results are promising, and we don't see any inventory loss in quarter 4 now.
Right. Just one question related to that. We've seen, obviously a realization drop. So while volumes continue to be very strong in the pipe segment, do we expect that Q4 realizations also will rise? Because obviously PVC prices have increased.
Of course, sir. They have already started realizing, and we will realize it. As I already said, since we are not declaring, it is already on the rise.
Right. And so, some comments on the margins. You did mention about, targeting double-digit margins.
Yes, sir. So they will be somewhere around 10% of EBITDA.
So that will be for the next financial year, FY24?
Yeah.
For the coming quarters, this is a guidance on a broad, few quarters, next few quarters. Given the fact that the current inventory, fluctuations which were there, that has been absorbed. And based on the current market prices, given the fact there shouldn't be any substantial further drop. So that's what Mr. Rajesh was saying, that short to medium term guidance is around, double digits. And then future, as we move forward, the operating leverage will come into picture and the further margin expansion should happen by another 1 or 2%.
Sure. On the bathware segment, sir, if you can...
Yeah, hi. So this is Sudhanshu. So in the bathware segment, of course, we've had the gains which are coming to us now because of the fact that we are now a re-merged company along with our manufacturing. So that's already a part of our our financials right now. We've of course seen further increase in our input costs, especially in the gas side. And in Q3, we've taken a price increase of about 6% in sanitary ware and about 3 to 4% in faucet, which came about in the middle of the quarter 3. So we have seen that gain coming to us perhaps only in 1 month in the month of in quarter 3. However, we expect that to benefit us entirely in the Q4. So we believe that margin expansion will happen in the quarter 4 of this financial year as well. Additionally, what's also happening for us is that we are continuing to reduce our dependence on imports, which were a substantial portion of our, I won't say substantial, but a significant portion of our total outsourced products. We have started insourcing some of that, and we've also started converting into domestic sourcing for some of the sanitary ware requirements which we've had. I think that also will have a significant impact on our overall profit margin expansion. Lastly, to improve our efficiencies, we have taken up multiple DTV projects, design to value projects. Many of these projects are under execution. We believe that some of their benefits will start flowing to us in quarter 4. Are we audible?
You are. Hello, Mr. Shah. Sir, there is no response from the line of Mr. Shah. We'll move on to the next question. The next question is from the line of Praveen Sahai from Prabhudas Lilladher. Kindly proceed.
Yeah, hi sir. Thank you for taking my question. So the first question is related to the bathware segment, and just to add into the last participant question, if I look at the PBT margin from last year same quarter on the lower side, and I believe because of the AGI Green Pack acquisition, this is on the lower side. So by any chance we will reach to the PBT margin at that level of the last year?
So basically, if you see, till 31st March 2022, this entire operations of bath product was in 2 different companies, in fact, the entire building products. So we have, historically communicated that the rationality of the acquisition. So now everything is into one company. We were historically buying on an arm's length basis based on an independent pricing mechanism. So whatever the cost of production there was in the previous company and a markup margin, that entire thing is now getting, accumulated here. But the margins of those, 1-to-1 apple to apple is not being seen at the EBIT level because there has been fluctuation in the raw material prices, like, we've talked about pipe prices, we've talked about gas prices and the brass prices historically. So we are not able to demonstrate on this, the entire costing, how the costing behavior has changed as such. But the entire benefit of that is getting flowed out here. The only difference is that majority of, or some part of the capex which was incurred before the acquisition in the other company, there was some interest component, but our transaction was on EBIT basis. So since we have acquired this now through a debt, so there is a interest component which in next 1 or 2 years we have given guidance should come down with the profits which are going to earn, and ultimately those margins will start flowing back.
Okay, got it. And because Q on Q also, we can see that the net banking debt has increased. So last quarter you had not consolidated entirely, or there is an incremental of 124 crore?
So generally in Q3, by the end of Q3, we accumulate some inventory because we are still buying a lot of inventory from China. And being a Chinese New Year for month of Q4, the inventory accumulation generally happens in the industry. So this by the end of March you will see some inventory coming down, and accordingly with the realization the bank debt will also come down.
Okay, got it. And the next question is related to the consumer appliances.
Yes.
There also there is a contraction in the margin. So what's the basic reason for that?
So if you see historically, we also spoken about this markets in we operate. These are highly fragmented market, let it be kitchen chimneys or air coolers and other things. So the overall increase in the input prices, the industry as such has not been able to pass on to the consumer. So if you see many of the competitors, their margins also have shrunk. And in order to sell more volumes, we had to do more, BTL activities on the ground. We had to, incentivize the distribution. So that is why we feel that unless some recovery happens in the market, for 1 or 2 quarters, we expect the current trends of the margin will continue. And thereafter, with the volumes picking up and also some easing happening on the input prices, then the margin extension should happen.
Okay. Thank you. That's it from my side.
Thank you. The next question is from the line of Nikhil Gada from Abacus AMC. Can you proceed?
Yeah, hi. Thanks for the opportunity. So just first, I would like to continue with the previous question regarding the margins in consumer appliances business. I believe that we were targeting the range on an EBIT level. We were targeting a range of close to 5 to 6% in next couple of years, and now that we are seeing such kind of an impact in discretionary demand, as well as the input prices still being on the higher side, do you want to revisit that guidance, or is there any change in the guidance for that specific margins, if you can highlight please?
So generally all these guidances are given based on the current market conditions. Like we had historically given guidance on pipes business and the consumer business. So on the pipes business, we feel that we will be, we'll be achieving those targets much faster than what we have committed by 2025. But on the consumer side, based on the current market condition today, we may feel that it may take another year or so in achieving those targets. But on the pipe side, we'll achieve a year ahead of it. On the margin side also, Nikhil, we feel that the problems may still be there in the economy on the macro side, with the inflationary trends, rise in interest prices, and of late in many IT sectors, the job losses are there, which has been there, which may have a short-term impact on the margins. But that's why we said, for 1 or 2 quarters, we feel that margin pressure will be there, and then it should start easing out.
Sir, if I rephrase the question, according to you, I'm just specifically asking for FY22. I'm not going to hold you for that, but just from your perspective, what kind of sustainable margins do you believe is achievable for FY24? The current scenario.
You're talking of the EBIT margin for consumer product?
Yes.
So somewhere, I can talk about EBITDA margins here broadly.
Would do, sir.
So EBITDA margins ranging around 6% to 7% for the next financial year as a whole. But again, this have some variations on the quarter because few of our products are seasonal in nature. So then it does impact. This is based on the current market condition and the current input prices trend.
Understood, sir. Got it. Secondly, sir, just on the pipes business, and you sort of mentioned...
And this was relating to consumer product only,
Got it, sir. Got it. Yeah. So just on the plastic pipes business, could you help us, in terms of the inventory that we were carrying in 3Q, in terms of finished goods and, resins, because just to sort of understand what led to this such high kind of inventory loss, because, obviously you mentioned it, but definitely it's still very much similar to what we saw in 2Q as well. And in 3Q, we in fact saw some improvement in prices as well. So a bit confused over there, please.
So if you see on 31st of March, we can give not on a quarter to quarter. 31st of March, total inventory in pipes was around 213 crores, which is right now at 182 crores. But there is a substantial volume increase also. But on a number of days basis, we reduced from 129 to 86 days. The challenge in the market was that last year, as the prices were rising, input material availability was a question. And with a sudden drop, the absorption of that pricing became a problem in the market.
Understood. Okay, fair enough. And so just, quickly on the entire balance sheet perspective, we already have seen that the debt levels have increased, by another 200 odd crores, purely maybe because of working capital and also as we are expanding our business. Can you just give us a number in terms of what kind of a peak debt levels, from both long-term, short-term borrowings perspective, do we, envisage at least for FY24, beyond which we don't see the absolute debt levels increasing?
So if you see, there are two things,
Yeah.
The overall input cycle cost has increased, point number one, as compared to last year. For many of our products, like based on whatever sanitary ware we were sourcing last year, the input prices broadly would have increased by 15 to 20% plus. Let it be the brass or let it be, the sanitary ware products. On the pipe side, it's the inverse, which is there. So we feel that there will be some reduction in the ballpark estimate is in next 1 year we should be able to pay off a debt ranging between 100 and 125 crores. Based on, the reduction in working capital, and the profits which we are going to earn will also actually, because there is no other, we don't have a subsidy and we don't have any other, investment opportunity. So whatever we earn, EBITDA net of interest and other taxes, so ultimately go for the reduction of debt only.
So if I assume around 700 to 600 to 700 odd crores for FY24, that is something as a debt level that we should work with. That is what you're guiding for.
Yes, but there will be some expansion, like pipe expansion we have to do because of the fast growing.
So I'm asking including that number. So if you could sort of, because I think we're doing some 180 crores in that. So
then we'll have to work out and maybe separately we can communicate this to you.
Okay, sir, fine. And sir, just lastly on the working capital aspect as well, specifically for the bathware division, I think, prior to the acquisition of the manufacturing, or rather once we had done the manufacturing acquisition, you had said that between 12 to 18 months, we should see a normalization in working capital days. I know we are 9 months into it, but do you think in this next 6 odd months you believe that we will see the normalization in inventory and overall working capital cycle?
Yeah, we stand by that guidance. We believe the inventory reduction, what you're seeing currently in the enhanced inventory, as I explained earlier, is because of seasonality, because of our dependence on imports right now, and because of the fact that in Q4 we get the Chinese New Year. Like I discussed earlier, we have all our plans to, in-source as well as locally source some of our non-manufactured items, as well as, correction of this inventory which is going to happen, the increase which happened because of the acquisition there. So we stand by our guidance of, anywhere between 12 to 18 months, we will see a normalization of inventory in the basket.
Got it, sir. Thank you for answering all my questions. I'll come back in. Thank you.
Thank you. As a reminder to participants, if you wish to ask a question, kindly press star 1. The next question is from the line of Vignesh Iyer from Sequent Investments. Kindly proceed.
Sir, yes. I just want to know, like in quarter three, what is the utilization levels for faucets, bathware and pipes separately?
Realization level.
Utilization level.
Capacity utilization.
Capacity utilization. Sorry.
So nearly 103% utilization for sanitary ware. 100% utilization, you can say, and then faucet was underutilized to a certain extent to about 42%. Pipes, Rajesh, can you just?
Yeah. Since see Q3, actually we saw a huge drop in prices, which I already said. So I'll just tell you we had a growth of value growth of 31%, but a volume growth of 100%. So we had to produce all this in the same infrastructure. We were running at around 90% of capacity utilization in Q3. And on an average 9 months basis, it is 78% utilization.
You mean blended you were running at 90% and pipes was 103 and faucet was around 42, right? If I'm getting that right.
So sanitary ware was about 103 or let's say 100%.
Okay.
Faucet was about 42%.
Right.
And pipe was, Mr. Pajnu said, 90% in quarter three.
Okay, right. And if I could understand, for the 9 months, what would be the cumulative price hike taken separately, if you could give again pipes, sanitary ware and faucet, but the cumulative for 9 months?
Your voice is not that clear.
Hold on.
Yeah.
Hello, am I audible now?
Yeah, it's much better now.
Yeah. Sorry, sir. Yeah. So I wanted to know for the 9 months, what is the cumulative price hike taken for pipes and sanitary ware faucet separately, if you could give?
So on the pipe side, the adjustment to prices is on a day-to-day or a week-to-week basis, which is there. On the price hikes on sanitary ware and faucets, Ashu can throw a line. So I just shared with you in Q3, middle of Q3, we increased our sanitary ware prices by approximately 6% and faucet about 3%. And we had taken a price hike in May as well, which was to the tune of, if I remember correctly, 6-7%. So I don't recall exact number, but give it to the tune of this 5 to 6%, I would say. So the cumulative would be a little different because they're having at different points in time. So from a point in time to another point in time, you can say about 10-12% in sanitary ware and about 8-9% to 7-9% in faucet.
Okay. So now as we see that PVC prices, more or less stable at this level, or it is better for as things stand, it is better for the company. Are we seeing some pressure where we might have to roll back the hikes?
This is for pipes?
In general, I mean. Pipes. It is for pipes.
Pipes, sir, it's like if the prices increase and decrease, proportionately with the same percentages, the end price increases and decreases. So since we had gone down by around 42%, now in March there is a correction and we have gone back up again by 8%. And we expect that in the next quarter, the prices are going to go up only, and we'll be taking those hikes only. There will be no drop in prices.
Okay. Got it. Yeah, fine. Thank you, sir.
Thank you. The next question is from the line of Ankush Agrawal from Search Capital. Kindly proceed.
Hi, sir. Thank you for taking my question. Firstly, sir, I wanted to know the valuation at which we have
Sorry to interrupt, sir, but there is an echo coming from your voice. Can you use the handset if you are on speakerphone?
Yeah. Is it better now?
Yeah, kindly proceed.
So I wanted to know, the employee stock that we have given at the Hindware Limited level. So what valuation have we given it at?
So this is based on an independent valuation done by one of the big four. And
I wanted to know the absolute valuation, please. Any broad input?
That being an unlisted entity, we are not disclose that, but it is done at the arm's length basis and an independent valuation basis.
Right. Okay. So in continuation to that, so what is the reason for doing it at the subsidiary level and not at Hindware, HHIL level? I mean, is there a kind of, plan to have the Hindware building materials business separately listed in the future?
There are different plans for different entities. So this is one of the first steps wherein, the incentives for the employees in terms of the shares have been allotted to the key strategic people who will contribute directly to the growth of the businesses. We will review this and we are in a process that how we can do it for the other companies also as such. So because this is a very common trend now across the industry, so that each of the employee has to be aligned. Strategic employees have to be aligned with the business objectives. So there are plans we have historically spoken about that we will be raising growth capital at their level. And over a period of time, we'll see how the business emanates from there.
Secondly, sir, in the bathware business, so what would be cumulative price hikes you would have taken in last 1.5 years broadly?
It should be, on sanitary ware side, more than 20% plus. And faucets also, some range bound between 18 to 22%.
Okay, so going ahead, once, the inflationary pressure or materials pressure cools off, so do you see, a scenario wherein we will need to reduce prices? And if so, how do you see that affecting our growth? Because typically, growth is basically a mix of volume and price growth. But now, in the future, if you have to take price cuts, there would be a pressure on the overall growth because the price growth that was there typically would not be there. And the overall growth just has to come from the volume side. So any thoughts on that?
Yeah, so see, it's not as straightforward as this. What happens is, when I'm taking a 20% hike, my increase in my average selling price will not be to the tune of 20% because there's always a change in our mix because of some categories are more price sensitive. Some subcategories within the sanitary ware side or within the faucet side are more price sensitive than the others. So some consumer segments downgrade to make sure that the price hike doesn't come through. So similarly, when the inflationary pressure comes down, or maybe even prices reduce, what generally happens is that as organizations we tend to launch new models and we don't tend to reduce prices. So I'm not saying this is a rule by itself, but generally this is what happens. And like you are building a future scenario, I'm giving you a most probable answer. Generally what happens is you launch new models and these models are then of course taken in by those specific consumers who are more price sensitive. However, your popular models which have increased prices will maybe continue to sell. So it's very difficult to really create a situation where you can really give a predictive model as to what exactly would be your ASP increase versus a volume increase in a scenario like this. But to answer your question about price reduction, generally we don't do that. We introduce new models, and because of innovation, we believe that overall our overall average selling price keeps on increasing.
Mm-hmm. Yeah. Okay. Lastly, sir, what would be the overall capex for FY24 that we're looking at? If you can provide for individual segments, that could also be fine, but at overall level also.
But the voice is not clear that much. You are asking about capex.
Yeah, capex for FY24 for the individual segments.
So on bathware, there can be some debottlenecking investments on sanitary ware as we are reaching full capacity. The idea is to outsource more and more, but to also in-house various high value items into the factory. So some expenditure there, which should be odd, let's say around 20-30 crores in the next financial year. We'll continue to invest into development of various stores, which we can spend another 20 crores around in this. Apart from this, pipes project will start, in terms of the setting up of the capacity, which will be initially 12,500 in Roorkee and further expandable. So around, I think 70-80 crores of capex should happen, in terms of releasing the orders and doing other things relating to that project.
Right. So broadly about 120 odd crores of CapEx.
The voice is not clear.
Mr. Agarwal, we can't hear you, sir, clearly.
I'll get back in the floor for the question. Thank you.
Thank you. Participants, if you wish to ask a question, kindly press star 1. The next question is from the line of Zaki Nasir from Nasir Investment. Can you proceed?
Yeah, can you hear me?
Yes, we can.
Yes, sir, we can.
Sir, first of all, congratulations on your new plant which has come up for the consumer appliance for cheesers per se. I would like to know whether these have already been introduced in the market, or would there be a formal launch for the same? And what other products are in the pipeline? That is on the consumer front, sir. Number two, would it be safe to assume that starting next financial year, you could start doing a run rate of 800 crores a quarter and end the year with 10+% EBITDA margin? Thank you, sir.
So on the new plant, which is water heater plant, I understand you are talking.
Yes, sir.
Yeah, the plant is capable of doing around 6 lakh pieces and can reach a turnover ranging 250 to 300 crores plus over a period of time, assuming what type and what value. I'm assuming that average price realization which we generate is around 4,000 to 5,000 rupees per product from this. But this is a good initiative in the sense that the market potential for this business is good. And we see that in next 2 years, this capacity should get fully utilized. Initially, the entire material may not be sold in India, so we might be exporting this to other countries, nearby SAARC countries. On your second question, it's not clear. Can you just repeat the second question?
Sir, considering this new plant launch and growth in your building products also, would it be safe to assume that you will clock a run rate of 800 crores combined per quarter from the next financial year onwards, sir, with a double-digit EBITDA margin?
So if you see, we in this quarter we had around 700 crores, 112 crores of consolidated turnover, and going forward, we feel that the numbers which you are talking should be achieved easily. But we generally avoid giving nearby quarters guidance. We had given our guidances on a medium to long term range around 2 years back, and we are still holding on to it, and we have performed according to it. We have missed few parts, especially relating to consumer, but on the pipes, like I was telling, we may be reaching the targets much ahead of the time. And on the sanitary ware faucet, if you see 9 month performance, we are there. But on a quarter, again, there's some flip-on happen. But we are holding on to the trajectory, which we had talked about last year.
Thank you, sir. That's appreciated, sir.
Thank you.
Thank you. The next question is from the line of Suresh Sangwan, individual investor. Kindly proceed.
Thanks for the opportunity. I have a question on the consumer appliances business and the retail one. Are there any leadership plans after Rakesh Paul left?
So, there are number 2 guys, and it's not that only one person was running the organization. So we have a full set of team which runs the entire operation. And there is a committee which has been formed which is actively looking into the business and its full level of sales and profitability. We are in process of, looking out for the new CEO, but it may take some time, because generally these positions are strategic in nature. But as such, the business operations are going on. There's no issue on that.
Mm-hmm. And any new product categories that are planned to be launched in maybe not very near term, but in maybe next FY24? Any new segments that have been identified?
So we keep evaluating various options, but nothing, a new category has been, approved by the board as such. The focus today is on 3 items as such. One is the kitchen appliances. Second is on the air cooling systems, which is air coolers and fans. And third is our, water heating or the heating solutions, wherein that is a part of a JV today. But these are the 3 categories in which we feel that still a lot of potential is there. And apart from it, we had launched kitchen fittings, which we sourced from the Italian partners. So that is also, started taking shape now, that business. So we are there now, 3-4 categories. In the near future, no such things. And if anything is there, once approved by the board, we'll inform accordingly.
Okay. And lastly, the brand stores. Can you explain a bit more? Like who, is it a company operated or on franchising model, and what all products in a single brand store are available from Hindware?
Yeah. So brand stores. So for example, in BPD, the bath product business, if you have a brand store for Hindware brand, we kind of display all the sanitary ware, faucet, products which are branded Hindware in that store. And this the model is basically dealer invests in the, so the company doesn't own the store, the dealer owns the store. Company is a part of the capital investment which is required to do up the store. And then the rest of the capital is actually brought in by the dealer himself. So there's a stake in the whole game from the dealer side as well. For a certain size and above, we may give a promoter to the dealer or to sell the product. But we don't give it to everybody. It depends on the size of that brand store which is operational right now. So that's how it works. It's sorry.
Yeah, so are these exclusive Hindware stores, or is it kind of like some small section might be just for the Hindware shop-in-shop kind of?
So generally, we try to get them exclusive, but a large number of dealers are multi-brand here. So we then may end up getting a part of the store as a Hindware store. So we generally have a form of nothing less than 500 to 600 square feet. That's the minimum requirement, and we even have stores which are as large as 5,000 square feet. So depending on the size which is available with the dealer, we make these decisions. We have various through which we execute a certain design of a brand store depending on the size available with the dealer.
Okay. And these counts that we are publishing, the brand store count, is that for the exclusive one or combined?
So the brand store in itself is exclusive, right? It's just that at times it's a part of a large multi-brand setup. At times it's 100% exclusive. But the brand store in itself is exclusive.
Okay.
But if you're asking, is it a part of a multi-brand setup or an exclusive setup? It's what the number I'm sharing is a combined number.
Okay. That's the answer.
Thank you. The next question is from the line of Dhiral from Phillip Capital, PCG. Kindly proceed.
Yeah, good afternoon, sir. Thanks for the opportunity. Sir, I have 3 questions. So where are we in terms of reduction in sourcing from China for our bathware and consumer division?
When you say where are we, you mean in terms of what are we doing about it?
So how much we have reduced the dependence on China?
Yeah, so we are in the process of reduction as we speak, and for us, it's actually come down by about 25% over the previous year, and we plan to kind of bring it down by another 25%. So we will be over FY22, we will be less than 50% of what we did in terms of imports from China. So that's the plan. We will still be having maybe a 9 to 10% of our total, total cost of goods coming out of an imported product. But it will be a substantial reduction over what we are doing currently.
So this includes for both the divisions, sir, bathware and consumer?
Yes. No, this is what I'm talking about is basically bathware.
And how about
on the consumer side, the initiatives have been launched. Like we have already identified 2 or 3 domestic vendors, and we are working very strategically with them, who operates with our molds. And the figure in terms of reduction is not substantial right now, but what we have done is around 10 to 15% reduction has happened there. But the focus is to further achieve those numbers over a period of time. So within the group, I think we have initiated many initiatives which focuses on Make in India approach, and it gives us a benefit of a local sourcing, as well as it also reduces the inventory fluctuations. Like especially when you're sourcing from China on the calendar year, and you'll have to source much of material because of the Chinese holidays. So a number of initiatives have been done across various business segments.
Okay. And sir, in the current environment, looking at the challenges which we have seen in our consumer business and the high inventory in the bathware segment, can you guide, how much our targeted working capital will be by March 23 end?
So March 23 end is too close a figure, but I think I can tell you next 12 to...
by next year,
Yeah, next 12 to 18 months, our endeavor is to reduce this by 20% plus.
And so, in the absolute term, what would be our working capital cycle right now?
So, if you see on a consolidated basis, if you see the working capital cycle, that is around. So, this is separate for each business. Just 1 minute. So, net working capital cycle for bathware business is 122 days. And for the pipes business is on 65 days, and consumer is another 130, 140 days. So but that is on a weighted average basis. So endeavor is to reduce this by 20% in the next 12 to 18 months.
Thank you. Participants are requested to restrict your questions to 2 per participant. The next question is from the line of Tushar from Kamayakya Wealth Management. Kindly proceed.
Yeah, good afternoon, sir, and congratulations for the good set of numbers. I have 3-4 questions on all of the divisions. The first question would be on pipe division. And sir, in the pipe division, have you flushed out all the high cost inventory in the pipes?
So Rajesh, if you can.
Yeah. We have almost consumed all that inventory, because now since the prices have gone up, and Q4 we have started with a very low base of inventory, and now all the inventory is coming at the current rates, and also the selling prices have gone up now.
Okay, sir.
So that's why I said we won't be having any inventory loss in Q4.
Fair enough. So the next question is on the sanitary ware. So now it's been a decent time for this asset transfer. But when can we expect the margin expansion for the same?
What is the question? I couldn't hear it clearly.
So you guided earlier for some margin expansion in the sanitary ware business as we are getting as we are transferring this assets. So when can we expect that margin expansion to happen?
So you're talking margin expansion in sanitary ware?
Yeah.
So it's already happening. If you see on a sequential quarter, the margin expansion is already done. And I think you're talking about acquisition of manufacturing and the margin expansion.
Yes, sir, you're correct. Yeah.
So basically, again, reiterating the fact that, whatever we had acquired as a manufacturing, this, majority of the products are already being sourced from this third company from whom we bought the assets. So whatever, gross margin they were making as such at EBIT level, so they are already transforming here. So it's on an apple-to-apple comparison, it is not visible because the other factors, the input raw material prices, the selling prices, the other metrics have changed. But on a medium basis, we have given a guidances, and we still hold on. You can refer to few of our transcripts which we did in last 1 or 2 quarters. So it clearly shows, how the trajectory would be.
Okay. In the consumer appliance division, in terms of the government, the increase in the duty on the chimneys, so what implication it might have chimneys in the division?
There has increase in the duties, but a few elements. So our focus would be now to insource more, as we are saying that there is an initiative. But definitely in the short run, the input price material will start increasing from 1st April, and I think the industry will then have to pass this on to the consumer because already industry is under pressure because the shrinkage of the margin of other consumer players also in the similar field. So we'll have to pass this on over a period of time, to the consumers.
Thank you. Ladies and gentlemen, the management will be taking one last question. The next question is from the line of Nikhil Gara from Abacus. Kindly proceed.
Yeah, hi. Thanks for the follow-up, sir. Sir, just on the greenfield expansion in plastic pipes, where you mentioned that we'll spend somewhere around 70 to 80 crores. So this is not the entire capex amount, right? So just from that perspective, by when will this plant be commissioned?
So, Rajesh, if you can take this. So, I think the question was, what will be the capex in financial year 24? I think I answered that.
Yes, you answered that. So then from that perspective, how much will we incur in FY25? And I'm assuming then we'll start the plant in FY25, right?
Yeah, because it's a greenfield plant, so we'll do most of the ground activities in the next 12 months. Rajesh, if you can take this, please.
Yeah. We have already filed our papers, so we will be starting the construction of the plant maybe down the line some 4 months from now. And then we may, somewhere around mid of FY25 or maybe third quarter, we may culminate this project. And then we'll go for the production.
So basically from third quarter of fiscal year 25, we should start seeing the products from the new plant, right?
Yes, sir.
And this, I'm assuming this 180 crore number is still the number that we're looking for the capex front in this plant.
Yeah. But earlier, Mr. Sikka was just referring to, because the question was asked for this year's capex.
No, so I understand. So 80 crores we'll spend in FY24 and the remaining 100 crores in FY25.
Yes.
I get a math right. Okay, sir. Fair enough. Got it. Thank you so much.
Thank you. The last question is from the line of Ankush Agrawal from Surge Capital. Kindly proceed.
Yeah. So can you provide me with the quarterly cash interest payment, and what is the lease rental for each quarter?
You want to see what is the cash and what is
yeah.
Just hold on. Yeah. So in the quarter, in the consolidated, interest on account of lease rental is 4.46, and in 9 months it is 13.66.
Okay. No, what I was trying to understand is the actual cash interest outgoing on account of debt, and what is the lease rental that is being captured in the interest and depreciation line items. So I get a better sense of the clear EBITDA picture of the actual cash outgoings for the interest on debt.
Yes. Have I answered? Because your voice is again, I don't know if it's a system issue or the voice is breaking.
No, what I'm saying is, what is the actual quarterly interest outgoing on account of debt, okay, which is actual because...
like in the quarter, the total consolidated interest is 22 crores, so you have to subtract 7.29 from that, so almost half of the interest.
Okay, half interest is on account of debt and half is on account of lease rental.
And no, half is on the interest. No. I think the question is different. So the lease rental that accumulated in depreciation is 9.62 and is 4.46 for the quarter. The total lease rental value, and for the 9 months it's 29.09 and 13.66.
Right. And so just a clarification on the presentation, when we give EBITDA numbers for each segment, I believe this is the reported accounting numbers, not before like India 116, right?
So all the reporting is as per the India's financials.
India's. So that does work. Thank you.
Thank you. That was the last question. I now hand the conference over to the management for closing comments.
Thank you everybody for joining the call today. And I understand the results are here to, they have some elements like, the fluctuation of input prices and other elements on the current macroeconomic conditions. Going forward, I think we have given guidances and we still hold on to this. This is that. Thanks again. I think we'll be again in touch when we close the full financial year 31st March 2023. Thank you very much.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.